Diversification is the only free lunch in investing, according to Nobel Prize laureate Harry Markowitz. But legends like Warren Buffett swear by putting huge bets on a few companies.
So, how many stocks should you own? Let's break down this crucial question.
Hey there, I'm Stephanie, tech veteran, engineer, and creator.
And I'm Bertrand, founder of App Economy Insights. Diversification is like the old saying, don't put all your eggs in one basket. By spreading investments, your nest egg isn't so dependent on any single company.
And this is why most retirement accounts use low-cost index funds or ETFs. You get exposure to hundreds of companies.
But there is a catch: over-diversification. When your portfolio perfectly mimics the market, it's almost impossible to outperform. Buying more random stocks just to diversify isn't a sound strategy. As Peter Lynch explained, a foolish diversity is the hobgoblin of small investors. Protecting the downside risk is the most important step, but it can also compromise the upside potential and dilute returns.
Right, investing isn't about dodging risk. It's about managing it to fit your unique situation. There are three types of risks to manage. There's market risk, boats move up and down with the tide. There's also sector risk, for example, the tech stocks in 2000 or banks in 2008. And there's company risk. Even great businesses can fail. Market risk is unavoidable, but sector and company risks can be tempered by spreading your allocation across uncorrelated investments.
From here, the right number of stocks hinges on three aspects of your risk profile. First, risk appetite. That's your goals. Do you need to protect any downside at all costs? Or are you trying to build wealth and seeking higher returns?
Then we have risk tolerance. It's the uncertainty you can handle. This is the sleepless nights factor. Market swings keep you up? Well, diversification gives you peace of mind.
And finally, we have risk capacity. Can you truly absorb losses without ruining long-term plans? If not, diversification is your safety net.
How long you'll be able to stay invested is also a critical factor. An individual stock can be extremely volatile in the short term. You can afford to be more concentrated if your time horizon allows you to recover potential short-term losses. If your time horizon, however, is less than 5 years, the number of stocks you should own is probably zero.
Tools like the Efficient Frontier help measure portfolio volatility and find the sweet spot between risk and return. But remember, short-term volatility doesn't equal permanent loss. For many investors, protecting themselves against a single stock tanking the portfolio is their biggest concern. But we need to zoom out.
Active investors who constantly research and trade might choose less diversification in their pursuit of big returns. Passive investors, on the other hand, they take a long-term buy and hold approach and often diversify more to limit volatility.
I explained my strategy in another video on our channel where we discuss Robert G. Kirby's approach of being passively active. In short, it involves diligent research upfront, then letting time and compounding do the work. If you do this, big winners tend to naturally become a larger portion of the portfolio as they grow. But it's the portfolio that concentrates for you based on its performance.
Warren Buffett and Charlie Munger have been poster children for concentrated bets, showcasing massive returns on a select few companies over time. Buffett calls diversification a protection against ignorance.
Buffett's approach is to only focus on the very best ideas. He loves the concept that you have a ticket with 20 slots in it, representing all the investments you get to make in a lifetime, forcing you to think very carefully. This is critical. If you're going to invest big in a single investment, you must know what you're doing. Just like buying a house or a car, you need to do your research.
Right, but there are considerations. Higher risk. When you have fewer stocks, any stumble hurts more, of course. There's also emotional challenge. Holding concentrated positions through downturns takes iron discipline, especially if you haven't deeply researched the company. I mean, you can always be wrong. As Murphy's Law goes, anything that can go wrong will go wrong. Most companies have periods of challenges, making it difficult to stay the course if it is a large position in a portfolio. And it's more challenging to let winners run. It's crucial to resist selling winners too early, yet letting them become a larger share of your portfolio naturally increases its reliance on these positions.
Buffett's own portfolio shows the difference between stock count versus portfolio allocation. Even while owning dozens of stocks, Apple is half of his portfolio, and 5 stocks represent over 80% of his portfolio. In short, allocation matters more than the exact number of stocks in a portfolio.
Diversification helps protect your downside and provides exposure to the market's overall growth. No single company can then hurt your long-term goals. On the flip side, winners do get diluted. Even your best performance have less impact overall, and this potentially leads to mediocre returns. In addition, tracking many investments can get complex and time-consuming. If you like this video, yes, we are gonna ask again, smash that subscribe button.
It may not seem like much, but it really helps our video be discovered for us to keep bringing you more content around tech, business, and investing. So the right number of stocks in a portfolio is unique to you. There's no magic number. Look, someone like Peter Lynch outperformed the market for 13 years at Fidelity while owning as many as 1,400 stocks.
The only right number is the one that works for you so that you can stay focused on the long run. Morgan Housel has a great quote in his book, The Psychology of Money. Aiming to be mostly reasonable works better than trying to be coldly rational. So it's okay to make financial decisions based in part on how you want to feel.
You must factor in your circumstances and how your portfolio is likely to evolve over time. So here are a few techniques to guide you. The first one is safeguards. Set maximum percentages for sectors or individual stocks to control concentration levels.
Core satellite. So use index funds for the foundation of your finances for stability and add a few higher conviction investments on individual companies that you believe in.
Next, quality matters. Concentrated portfolios are safer with predictable, proven companies versus less stable, high-growth upstarts. Buffett has half of his portfolio in Apple, right? But not Snapchat. The size of the investment should be adapted to the probability of success.
Blackstar funds looked at 8,000 stocks over 23 years. And their conclusion? In short, out of a portfolio of 10 stocks over 20 years, on average, 2 stocks are going to return 300% or better. 2 stocks are going to be wiped out, down 75% or more. And then the other 6 are just going to cancel each other out.
So you see, even with average luck, some concentration in your portfolio is inevitable as the story unfolds. And you want to keep that in mind if you decide to invest only in a handful of stocks. Chances are, there is a best performer in there that's going to overtake the portfolio. Make sure you're comfortable with that. Why? Because a critical success factor will be to leave it alone and resist the temptation to sell. As best put by Charlie Munger, the first rule of compounding, never interrupt it unnecessarily.
Yes, discipline is everything. Your biggest enemy often isn't the market, but your own emotions. So document your investment decisions and review your portfolio regularly, but resist the urge to constantly tinker. Winners often need many years to fully blossom.
Ultimately, the right number of stocks in a portfolio is different for everyone. It depends on your knowledge, risk profile, and goals. Think critically about those and adjust your approach accordingly.
Now it's your turn. How many stocks are in your portfolio and why? And what safeguards do you use to protect your downside? Tell us in the comments below.